Good morning, everyone. Thank you for joining us on another of our Pulse webinars. We're just waiting for everyone to get logged in and signed in, and then we'll start off with today's presentation. So we've got Simon with us here today from Quilter Cheviot. So Simon is the head of MPS at Quilter Cheviot, and really looking forward to hearing what you've got to say, navigating choppy waters. Obviously, there's a lot going on at the moment, as there seems to be constantly at the moment. And what Simon's going to go through is looking at, what's going on within the markets, the geopolitical forces that are happening, resilient earnings. Can't be a webinar at the moment without touching on AI. And obviously, there's quite a lot of sector divergence. I think Simon's going to go through all of that in a bit more detail on today's presentation. It's a very timely market update as well, so I think it'll be really useful for everyone. So as normal, we have our Q&A button at the bottom. So if you have any questions throughout, if you could pop your questions in there, and there'll be time at the end for Simon to answer any of those questions. So appreciate everyone joining us today on a slightly gloomier day than what we've been enjoying over the past few weeks. But hopefully what Simon's got to say will give us some positivity and cheer us all up a little bit. So what I'm going to do now is, I think quite a lot of people have dialed in. I'm going to hand it over to Simon and today's presentation. Thank you very much.
Well, Linda, thanks very much. And hello, everyone. Really appreciate your time. Delighted to be here. And as you've heard, there is a lot to take in. And I've been traveling quite a bit the last couple of weeks, speaking to professional partners and advisors. One of the key takeaways that I've really drawn is, that disconnect between clients' expectations when coming in for review meetings, given the unfailingly negative barrage of headlines that we've been having in recent months, and the surprise that they, in many instances, demonstrate when looking at markets being at all-time highs, and in many cases, portfolio values being at all-time highs as well. So I think it's really important just to take a step back. Let's kick things off by reviewing why we are in the situation we're in, and just having a look at what's driven markets over the course of 2026 to date. We'll then obviously focus, as the presentation title alludes to, at the opportunities that we continue to see across markets. We'll also look at the risks. I don't want to dismiss those as well. And, we are still in an unstable environment. But to kind of echo what Linda said, our key thesis at the moment is there's still a lot to be positive about. And, it's a case of digging through and really looking at what is out there, and the opportunities that we see continuing to present themselves. So let's start off, as I said, by just winding back the clock and looking at what has driven markets year to date. So, first thing to highlight, and I'm quoting the executive director of the IEA here, is that the world has experienced energy supply disruption that is unparalleled in its magnitude. And while you can see at the top of the chart there that, the oil price has certainly spiked, to look at double-digit returns from global equities thus far in 2026, given that initial statement that I made, would probably have had a few people scratching their heads if that had been a forecast given at the beginning of the year, given the geopolitical news that we've had. So it's really, really important to just take a step back and understand how we came into 2026, because it is and has been a positive backdrop that really underpinned the gains that we saw in the first 2 months of the year, ahead of the advent of the Iran-Israel-US conflict. So, we saw a very positive January and February. That was despite all of the uncertainty that was created by circumstances in Venezuela. Let's not forget, that prior to the immediate conflict, there was a lot of turbulence and instability in Iran as well. And of course, closer to home in Europe, we had the debacle or ongoing dispute about the future of Greenland. And, a lot of these things really unsettled markets. But markets ultimately looked through them. And that was because they came into 2026 with a lot of momentum and sound economic fundamentals, really driving things forward. So we saw in January and February a very diverse segment of the global equity market delivering some very strong returns for investors. We saw the UK do well, partly down to the large allocation to defense stocks, but also looking at mining stocks as well. We saw Japan really riding a very, very positive tailwind of political development. So we saw, unanimous victory there for the Liberal Democratic Party, seen as having very pro-market views and policies. And emerging markets also continue to benefit from the tailwinds that they were exhibiting and benefiting from in 2025. Obviously, the growing AI theme and the optimism surrounding that particular influence on markets, which I'll return to, led to 10% returns across the UK, Japan, and emerging markets in the first 2 months of the year. And in contrast, we saw a lot of investors moving away from the US. There was a slightly unusual scenario where we had, on one hand, the market questioning the potential return on the investment of these huge announcements of capex spending from the so-called hyperscalers. And at the other end of the spectrum, we had, a raft of disruption trades going through the market with people questioning whether AI was going to ultimately lead, to the torpedoing of a lot of business models in areas like software or property management, with the prospect of fewer people being employed and fewer offices, but also wealth managers. It just rippled through sector by sector, industry by industry. So really interesting dynamics in those first 2 months, but ultimately an environment that was really categorized by positive fiscal and positive monetary policy outlooks for 2026. We then obviously come into the final day of February, and it's an ultimate game changer. So markets subsequently have, if not been entirely dominated, have been heavily, heavily influenced by the advent of the crisis in the Middle East. And that led to a really sharp rotation in market leadership. So March saw some of those markets that had demonstrated the strongest returns in January and February ultimately struggling. In contrast, we saw the rise of the US equity market on a relative basis starting to outperform as investors took the view that the US was most robust in terms of its economic outlook, potentially least impacted by an energy supply side crisis, given its relative independence in that space, and obviously the quality of the earnings profile of many of its businesses as well. You also saw, a move to the dollar, although the dollar hasn't necessarily been the safe haven that it has demonstrated in the past. So we saw very strong relative performance from the US in March. Interestingly, it is, important to highlight that traditional safe havens did not necessarily behave very well in March in the way that one might have anticipated. So gold had, a particularly weak month. A lot of that is down to the strength of the gold price in the preceding 12 months. So I don't think it should necessarily be over-egged, but it wasn't necessarily the safe haven people had anticipated. It could be in a risk-off environment. And the other area, which I will touch upon in a bit more detail later on, is bonds. Bonds have not demonstrated that positivity and that ability to look through current geopolitical concerns in the same way equity markets have. And there are a number of reasons for this. As I say, I'll cover in more detail later on. So that is where we were year to date. If we look over the last 3 months, this covers the beginning of the Middle East crisis from the end of February through to the end of May. And as I say, even this period, stripping out those first positive 2 months of the year, is still showing positive returns for global equities. But that market leadership has changed. And you can see here that, yes, the oil price has continued to be elevated. Although, again, given the severity of the supply side crunch we've seen, many people have questioned why the oil price hasn't gone higher. And a lot of that is due to the drawing down of inventories that we've seen. But you've seen the US market continue to rally ahead over the last 2 months in particular. And that has really been driven by earnings. So that is a really important factor to highlight, that the strength that we've seen from equity markets has been supported by the fundamentals of a very, very strong earnings backdrop, most notably from tech, but not only from tech. And in contrast, as I say, you look down at some other sectors or some other areas that have less exposure to tech and more exposure to an energy crunch and a spike in energy prices. And we've seen the UK and Europe most exposed to that and underperforming over the last 3 months. We've seen areas like the property sector, very rate sensitive, exposed as well. And we've seen the long end of the gilt market and gold, as you can see here, struggle over that period. But again, it has generally speaking been a more positive environment than many investors would have envisaged at the beginning of the year. If we look over the last 12 months, it's a very different picture. And again, this I think goes back to that point I made earlier about, potentially 6 monthly or annual review meetings, where we were 12 months ago, where we are now. Crucially, we have gone through that rolling 12-month period of looking at the impact of Liberation Day, or so-called Liberation Day, back in April of 2025, where we saw that really sharp drawdown and that ensuing rally in markets. This has been a positive backdrop for equity investors, and almost overwhelmingly, it has been driven by fundamentals. There's been some racing ahead in areas like Europe, where there has been a lot of positivity in terms of the anticipation of strong fiscal support, but in many areas this has been led by earnings, and it hasn't, crucially, just been a US tech or a tech sector story. It has been broad-based, which again is a positive in terms of the robustness of the market backdrop that we're in. I thought it might be useful just to have a look at some of this in a little bit more detail by splitting out factors, be that value versus growth companies, excuse the jargon, or large cap versus small cap. And it is very interesting to look at this because there are a couple, I think, of key takeaways that are worth digging into in a little bit more detail. So firstly, I've spoken a lot about the strength that we've seen over the last 3 months. If you look at the top left-hand side of this chart, large cap US growth stocks have done extremely well. And as I say, that is a combination of the robustness of those companies, the sheer quality of the earnings profile, and great earnings updates that we've seen from the tech sector in particular. And you can see that in terms of the underlying bar chart as well, just showing how strong tech has been over the last 3 months. But it hasn't just been about tech. And again, I think, talking about the importance of diversification, the focus on looking at opportunities away from just one sector that continues to grab the headlines. If we look at, say, the UK and we look at large cap UK value over the last 12 months, well, that has been a phenomenal return that surpasses even that of large cap US growth. And that has been a combination of materials, energy, telecommunication services, real strength there, as well as financials, a large, segment of the UK banking industry doing particularly well too. So it really emphasizes why we see the opportunity, not just in the US, albeit we do like a lot of those names that have demonstrated real strength recently. But it is a case of, just building that picture. And even in the US, where I've focused, on the recent strength of the large cap segment of the market, if you look at small cap growth, that has been a phenomenal performer over the last 12 months. The best performer here, as you can see, with that return of nearly 44%. So the takeaway is, it is broad-based. Opportunities exist, not just in the largest market in the world, but elsewhere too. And we are focused on looking to try and identify not just particular themes, but looking at stock-specific opportunities. Now, something that has cropped up in a lot of my conversations with professional partners and advisors in recent weeks has been around valuation. And valuation has been a topic of conversation now, I would say, for the last 12 months, if not longer. And the worry is, particularly when talking to investors, that we are in a market that is demonstrating some very elevated multiples. How long can that continue? Am I better placed just waiting for a dip? And I think, obviously, what we've seen this year is, the importance of remaining invested and not trying to time the market, be that in terms of an entry point or an exit point, in the anticipation of jumping back in at a more opportune moment, has demonstrated that, that is a very dangerous game to play, and market sentiment can turn on a dime. Valuations, looking at the headline MSCI World Index, are above their long-term averages, but they are not overly stretched when looking in aggregate. So we're looking at around a just under 18 times forward earnings multiple at this point in time. And if I break that down, you are looking at emerging markets and China trading below their long-term averages, roughly around 11 times or so. The UK trading below its long-term average. The Eurozone trading around in line with its 20-year average, and Japan also looking below its long-term average, although I would just caveat that is quite skewed by the exuberance we've seen in previous decades relating to that market. So it is not an environment, not a backdrop where everything is trading at multiples significantly above their long-term averages. The elephant in the room, of course, is the US market, and the US market is trading above its long-term average. And that, I think, ties quite nicely into our view that there are pockets of exuberance, undoubtedly, in that market. And that is why it's important to be selective. But I would also just emphasize that the message is more nuanced than just looking at those long-term averages and current multiples. And going back to the quality of the earnings profile in the US stock market, that is a really, really important point to consider when looking at history. So firstly, earnings have continued to be strong. So US stocks have looked expensive for a long time, but largely speaking, we've seen the multiple remain broadly consistent in recent times. And that's because earnings have come through to meet those expectations. But also US profit margins have continued to improve and have improved quite materially from, say, where we were in the 1990s to where we are now in the 2020s. And they're not as stretched when accounting for that move in those margins. And if you rebase to account for that, they're trading, broadly speaking, in line with their long-term averages. And the overall ROE, the return on equity that the US market continues to demonstrate, is still pulling away from that of other global competitors or global peers. So we are saying that you are looking at, elevated prices for the US and certainly pockets of exuberance that cause us to pause and avoid certain names where we feel that the story or the thesis has run ahead of the demonstrable earnings profile. But it's an important distinguisher between saying the US is just too expensive versus no, there are some fantastic businesses that you want to own in that market and continue to merit exposure on clients' behalves. And we would also emphasize that isn't just about looking away from US tech, but very much within US tech and some of the semiconductor names where we still see a really strong business case for owning those names. Now, I said I'd return to bonds and, to revert back to a slightly less positive topic here. Bond markets, as I mentioned, have not been able to look through the current turmoil in the same way. And that's obviously a function of the nature of the asset class. There are a number of reasons for this. Now, the first, I think, most importantly to highlight is inflation. Particularly sensitive to inflation expectations and changes in inflation forecasts. And obviously, what we have seen with the advent of the crisis in the Middle East and the closure of the Strait of Hormuz is worries that we are going to see an inflationary spike and inflation and energy price inflation really, leach into core inflation across markets. So starting the beginning of 2026 and the expectation that we were coming into, a pretty significant rate cutting environment, there's been a rebasing of expectations. And, that coupled with the inflation concerns has meant that markets from a fixed interest perspective have looked very much at inflation as the primary fear rather than the economic slowdown possibility of where we are at the moment. And in that environment, bonds tend to do a lot better and provide that diversification in portfolios, obviously, where the anticipated move from central banks is to cut rates to stimulate growth. So that supply side nature of the shock has really led to that. I've put the UK government gilt yields here on this, but to a lesser extent, it can also be extrapolated across other developed markets, treasuries as well. The UK has had its own unique problems as well. Firstly, from an economic perspective, there's a perception that we are particularly exposed to an energy shock, given our dependency on external energy supply. There was a lot of unwinding of positions in the UK gilt market as well, where people had anticipated for rate cuts. Domestic political concerns is something of a euphemism when you think about just how unstable we've been for a number of years now in terms of our political environment. And obviously that's been very much exacerbated in recent months with the current government as well. And risks around the potential for a challenge to the current leadership, the potential pivot away from some of those fiscal rules and loosening of the purse strings at a time where sentiment towards the UK and questions around the credibility of our ability to maintain our fiscal position have risen in recent years, not just since 2022, but there's been a perception that we are too short-termist, unwilling to make difficult decisions. Put that all together in an environment where people are worrying about, increased levels of debt, increased inflation, and that's the reason why UK gilts have underperformed. Really interestingly, though, we have seen a pullback in the last month, and that is a function really of inflation in the UK coming back down and undershooting versus expectations. I wouldn't say coming back down, but expectations have come back down. Inflation was not as heightened as had been anticipated. You put then a deteriorating labour market in the mix as well. And again, that is the environment where bonds tend to do better. So going back to the point around portfolio construction, it's the reason why we continue to own fixed interest, and it's the reason why we continue to own gilts for our UK and sterling-based strategies and treasuries for our dollar-based strategies. But we need to be mindful that there are environments such as this where you don't necessarily get that level of diversification, so you have to look at alternative sources. The other thing to point to as well is credit and credit spreads. So, one of the reasons that we do have a tilt towards sovereign over credit and a focus on high quality investment grade over high yield is that spreads are extremely tight. And we saw a very small nudge up at the beginning of the current conflict in the Middle East. But they have continued to move on down. And, there are structural reasons for this. The view that corporates are in very good health, the quality profile of the index being better than it has been in previous decades, and some of the specific concerns around certain government bond markets and the structural story underpinning them. Put that all together, and that's the reason why you have tight spreads. So we are certainly of the view that there is merit in having credit exposure, but in terms of deploying risk budgets, our preference has been towards equities at the expense of the more esoteric segments of the credit market, given that spreads are as low as they are. So again, not saying that there isn't rationale for where they are, but there hasn't been an obvious buying opportunity to dramatically move the blend of credit or sovereign debt exposure that we have, or to pivot more towards credit at the expense of equities. So really interesting to see just how resilient this market or these markets have been in recent months as well. So let's focus now on where we are and our view for the rest of the year and beyond. So I started by really emphasizing the importance of fundamentals in the strength of equity markets that we've seen thus far in 2026. And it is really important to emphasize that, the corporate backdrop has been positive. And in many cases, it's continued to improve. And that is what markets have focused on. We saw a tremendous Q1 earnings season, which further bolstered sentiment, coupled with the announcement of the ceasefire in early April and the de-escalation of the rhetoric and actions that we've seen in the region in recent weeks. Although I would just caveat, obviously parking it as a key risk, is that we are still in the middle of a conflict, and that conflict is not yet resolved. But as I say, markets are looking through. Markets are looking at strong fundamentals. They're looking at strong earnings growth, a broad-based set of earnings expectations improving, not just focused on one particular sector, although tech is, as you can see here, particularly positive, given the updates that we've seen in recent weeks and months from the tech sector, not just in the US, but also looking at the Asian and emerging markets with the largest exposure, so your Korea, your Taiwan segments of the Chinese market, as well as sub allocations within areas like Europe as well, where there is some pretty sizable players in this space. So this is why markets are strong. This anchors our constructive outlook for where we are. But as I say, we are anchoring that position with some caveats and with some diversifiers to ensure that we are not betting the farm either on a particular theme or being aggressively risk on. We are mindful that there are still risks out there, and the market is still chewing over quite a few questions of where do we go if this conflict continues in the ensuing months into the summer, when inventories are really starting to get stretched. And that is a bit of a cliff edge in terms of nervousness for markets, even if the mood music seems to be pushing towards a constructive resolution and a longer term peace settlement. But first and foremost, our view is the earnings backdrop remains positive. It remains broad based. And it is not just a case of small segments of the global equity market that is providing that support. So digging into that in a little bit more detail, that is the basis for our modest overweight tilt towards equity markets. That tilt is across a number of different markets for reasons I'll go into in a little bit more detail. The slide here just outlines that. I don't expect or want you to look at this in at length, as I'll be going through some of these themes in a little bit more detail. If I move away from equities, I look at other asset classes, so alternatives and fixed income. Alternatives, obviously, a very broad-based description. We are, again, modestly underweight fixed income. That is a move that we've been making over the course of 2026 to date. Really on the basis that we want to add further diversification into portfolios. And the view that we've seen thus far in 2026 is that there's been a significant spike up in the correlations between equities and fixed income. Again, largely driven by the characteristics of the shock to markets that we've seen with the energy crisis that's arisen from the closure of the Strait of Hormuz and the conflict that we're seeing there. So fixed income continues to play a role, absolutely, but we see an environment where hedge and absolute return type strategies, trend following strategies, multi-asset managers who have the capability to pivot towards other asset classes, commodities, be that hard or precious metals, all have a role to play as well. If I look beyond that and look at areas like commercial property, that is an area where we were quite constructive last year. And in the sterling-based strategy, saw some very interesting corporate activity across a number of the REITs names that benefited performance as well. We've become a little less positive and have brought that back too. So it's been a case of adding to hedge funds, trimming fixed income, trimming commercial property, but remaining broadly constructive on equities and focusing our tactical overweights, if we're to use the jargon, on a number of different regions. So again, going into the details for why we see these opportunities is where I think we should go next. So speaking about the US and going back to the point around valuations, are we avoiding the US purely because of a high headline multiple? No. Are we being mindful of trying to seek opportunities to buy companies at a reasonable price that are exhibiting growth, rather than growth at any price? Absolutely. I would just caveat that where we are with this slide is where we were at the end of April. This data is yet to be produced from Friday to the end of May. And tech has had quite a significant rally over the course of the last few weeks, as I've just outlined. But we are absolutely still wanting to own some of those large cap, US tech heavyweights. And if we talk about the Mag 7, and it's really interesting to see that the market has been much more selective around the Mag 7 rather than it just trading as a basket of stocks that have done really well. But, we like a number of those names. We are overweight a number of those names. 4 out the 7 we're overweight. 2 out the 7 we're underweight. And the name that we don't own is Tesla, where we simply can't get comfortable with the multiple, alongside a couple of other reasons around the structure and corporate governance of the company. But ultimately, we want to pivot towards those names that we really like. So, this isn't a blindside on Tesla, which is a fantastic business, or indeed Elon Musk. It's more just a focus on let's allocate capital to those names where we have highest conviction and believe that we are paying a reasonable price for some fantastic earnings opportunities. And so ultimately, that is what leads us to have this mix of names here. So the Mag 7, 6 out of the 7 are owned. But it's not just about those names as well. Within tech, we are about at weight versus the index. We have a tilt towards semiconductors over software. I touched briefly upon the disruption trade that really started to ratchet up earlier in the year around the emergence of some of these tools, coming through from Claude and other players, and the worry that the terminal value of certain businesses, may end up being zero, whereas that had never been seen as a possibility until that point. That has led to a lot of disruption. That disruption theme has been tempered somewhat by a real focus on, the crisis in Iran. But ultimately, while we see some real opportunities in software to pick up names where we think that the share price is, unfairly challenged, and the business models and moats that these businesses have, are more than robust, and they are actually potential beneficiaries of AI. Our tilt is still towards semis over software. So, not just your Nvidias, although that is obviously the largest index constituent, but Broadcom, AMD, really interesting, and a phenomenal performer in recent times. Looking at TSMC as well, as a way of playing that, but not betting the farm on that theme, having healthy representation and being selective in the names in which we own. The UK is an interesting market, as I've already highlighted. And I, again, would always emphasize, as I know, our advisor partners do, that the UK stock market is a very, very different beast to the UK economy. And while there is a lot of negativity around the latter at the moment, there has been some very strong performance in recent times from the stock market. I mean, in particular, those large cap names where we are most tilted towards. So, defense through names like BAE, energy, which is a sector we've continued to be adding to in recent times. Even on the day of the ceasefire announcement, we decided we wanted to up our exposure on the basis of having a hedge against the prospect of this conflict continuing for longer than we'd anticipated. But also, the expectation that the oil price is likely to remain elevated given the disruption and damage that we've seen to infrastructure, and obviously the need to replenish inventories. So again, sensible portfolio management in our view, but a lot of these companies, trading at attractive multiples, and demonstrating very strong free cash flow yields. So we see merit in having that exposure, and the characteristics of the UK stock market with its large energy and materials exposure, again, supportive of a modest overweight position. Europe is where there's been a lot of debate, very exposed to a prolonged crisis and a sustained energy, spike. and question marks have been raised around the imminent nature of the fiscal tailwinds that enlarged infrastructure and defense spending as announced last year, and the removal of the German debt brake really bolstered sentiment and enthusiasm. We still have exposure to a number of companies in those areas that are going to benefit from that. So, we've been adding to some materials names. We continue to own defense exposure as well. And ASML, as you can see here, is very much tapped into what is this, buoyant AI theme around capex, which again, has continued to drive markets. So Europe is one of those allocations where we look and we think, probably the most challenged in terms of should the geopolitical backdrop worsen or not improve in the way that markets would anticipate, but some very attractive companies still within the mix within this region. And at this point, we have a modest overweight, although Europe is typically, a smaller weight across a lot of the strategies, given our strategic asset allocations. Emerging markets, I've talked about just how strong we've seen the returns be from EM. EM is such a broad descriptor, and as I say, there is a very, very significant difference between different markets there. Your Koreas and your Taiwans, versus your LATAMs, and even some of the European markets. So very difficult to give kind of a very headline description, other than to say, we continue to partner with some fantastic managers in this space to really dig into the opportunities they see, blending a combination of more growth orientated names with more value orientated mandates. This is an area where we still continue to maintain an overweight allocation to, and feel that the exposure to some of the AI beneficiaries in this space, through a number of the fund managers here, continues to be well supported in terms of the rationale. Japan, again, we're broadly speaking neutral versus the market there, as with Asia Pacific, with a tilt towards some of those EM names that have quite material exposure to those buoyant themes. I've talked about alternatives as well, and adding to hedge fund type strategies. This is the read through for sterling based exposures, our international MPS sterling strategies. Different for the dollar portfolios, obviously, given the exposure of UK property in the mix here. But ultimately, again, some benefits coming through from having that diversifying exposure. And I would just, highlight here that there are environments where hedge funds can demonstrate positive returns in a period where you see a real shock to fixed interest. So again, going back to the rationale as to why we increased our exposure to this asset class, having been underweight for a little while, and we are still modestly underweight to help fund our positive equity stance. But the case for having hedge fund exposure in portfolios, we would still argue, is very much intact and has actually increased in recent times as well. Fixed interest markets, again, I don't want to cover old ground, but just thought I'd visualize, for the sterling strategies, it's very much, conventional gilt exposure, some index linked exposure for the medium and medium high risk strategies, coupled with, what is overwhelmingly investment grade credit exposure as well. Very modest allocations to other areas where you get a slightly more esoteric profile. For our dollar strategies, very much US Treasury focused, again, with some strategic credit exposure alongside as well. So, very much a whistle stop tour. Very, very much appreciate the time. Couple of final points I would just highlight. The first is, to emphasize that the importance of staying invested is something that time and time again, advisors are there emphasizing to their clients. We saw that drawdown in 2025 around Liberation Day, and that was ultimately a very rewarding period for investors. We've seen a very similar experience for investors in 2026 so far. There are undoubtedly still risks out there. What I wouldn't want you to highlight is that it's just a everything is rosy type message, but we are trying to really dig into why markets have been so resilient, what the earnings profile is like for the companies that we want to have exposure to on behalf of clients, and how sustainable is that earnings outlook for those businesses, and put that all together. And that leads us to remain, cautiously constructive, mindful of those geopolitical concerns, really emphasizing the importance of selectivity. So, let's not just zero weight certain sectors or certain markets just because the multiple optically looks expensive, but real dig through and understand what's doing well and why. Keeping the quality profile of your bond allocation. There is a downside benefit to having that exposure, but be mindful that a supply shock, as we've seen, is a challenge at times for bonds. And inflation in particular remains a topic of concern within the market. The next few weeks and the developments across the current conflict are crucial in terms of determining next steps and the prospect of more severe economic scarring for the global economy. And given that, the importance of having alternative investment exposure within the mix, we see as being absolutely crucial as well. So I've tried to cover as much as I can, as succinctly as I can, in the time. I really appreciate, your attention. If you want to hear more, you can, dig into our thoughts, not just from an MPS perspective, but our colleagues across the broader business. You can have a chuckle. I promise you, I don't look like that picture nowadays. I don't know where that was dug up from Citywire when we were talking about the merits of adding to tech, in April, ahead of earnings season. But plenty of thought leadership from across the business around much of what's going on. So yes, plenty more there if you'd like to learn more about how we see the world. But I really appreciate your time. Thank you. And Linda, I will pass back to you if I may.
Absolutely. Thank you so much. It was really interesting, very in depth, and very thorough as well. And I'm sure that everyone that's been listening or listens online will really appreciate sort of the depth that you've gone into there and sort of splitting it out in the way that you have. I think for myself listening, the key takeaways were your quote on the pockets of exuberance. So sort of, keeping focus on that positivity side of things, but sort of leveling that with making sure that you're still treading carefully, looking to pause, avoid certain stocks, etc. So I thought it was a really, really useful and very thorough overview. And obviously, not surprisingly, we've had quite a few questions come in. So one of the questions have talking about your overview on your view on weightings. So what are your thoughts regarding the big IPOs that are on the horizon, SpaceX, etc., and what do you feel the impact of those might be on the markets?
It's a really good question. And I'd encourage you to keep an ear out for my colleague Ben Barringer, who's our tech analyst here, who regularly featured in both the industry and national press. So yeah, obviously, I would say dividing opinion around, is this potentially the top of the market? Is this does this bring back memories of the dot-com bubble?
Mm.
And is this something we should be worried about, given the questions around profitability? For some of these names, is this going to have quite a significant impact on the overall multiple of the market? Lots of things being discussed. So I would talk about the names that we own, and maybe frame kind of thoughts which will evolve over the year with that context. So, I mentioned not owning Tesla. It's only one of the names, that trades at really eye-watering multiples
Mm.
that we don't own. But looking at Nvidia and the fact that large cap tech, going back to April, very generic term, but you could buy many of these companies at the lowest multiple that they've been trading at for a very long time, and in some cases, you're looking at kind of near market multiples for what is a tremendous growth prospect. So the PEG ratio of a lot of these names that we own is actually very low, and we see the earnings coming through in a way that, again, kind of when there's comparisons made with the dot-com crisis or bubble and the ensuing kind of market crisis, just wasn't there. These are hugely cash generative businesses. They're demonstrating fantastic innovation. One of the real, turbo boosters of sentiment recently has been, the earnings updates, obviously, but the growing demand for cloud and a number of other kind of positive indicators. On the flip side, I'm not going to, and we've got some good pieces on this around the bubble-like concerns
Yeah.
that are coming through from things such as like vendor financing and the circular nature of some of this. So it's one of the reasons why, I go back to that point that we're not really, really overweight tech. We're being selective. We like it. We want exposure to the theme. It's been very beneficial. But, look at the sustainability of the CapEx, look at the profitability of the business, look at their business model, look at where they're going with their strategy. That's all got to be done, obviously, with IPOs. But I would say it's kind of another one in the, definitely something to think about in terms of the the case for or not having material exposure to this particular theme. So yeah, I would say definitely a good question. Appreciate it. Want to revisit a little later in the year as well.
Yeah, no, absolutely. Yeah. Conscious of time, so I've got I'm going to try and amalgamate a couple of the questions. One of the other themes that's come through is a couple of queries around interest rates and how important the sort of central bank decisions are likely going to be potentially for markets during the remainder of this year.
Yeah, really, really good question again, Linda. And I think, if I talk about risks to the market outlook and what is, undoubtedly a buoyant period of sentiment at the moment. So a continuation of the current conflict, absolutely. I would say central banks moving quite aggressively to raise rates. And that is something that, is keeping us and keeping investors up at night at the moment. What is the willingness of central banks to look through the current, the current crisis and really acknowledge that in some areas potentially, there could be potential pockets of weakness, or this is just and I hate to use the term, but a transitory blip around, a slowdown in economic growth and a spike in inflation. So I think it's very significant. It's definitely something where, we've already seen that move in bond markets, that have gone from pricing rate cuts to looking at, possibilities of rate rises. Are they going to be token in nature, or are they going to be something more substantial? It's definitely, a point to consider. And obviously with the new Fed chair and some of the comments that have been made previously, again, something we are looking at, on a daily basis as to, trying to glean the direction of travel there.
I can imagine. And just to sort of wrap up, I think someone who's asked this question has been on a couple of our webinars before, because it's one of my favorite last questions for our presenters is giving you a crystal ball. And if we were to sit here in a year from now, what do you think would be the biggest surprise for investors?
Oh, that's a fantastic
Good. Yeah, good question.
to raise. So, we are likely to see ebbs and flows in terms of sentiment. It's a given in markets. We've seen it already several times this year. At the moment, there is a real focus on, the sustainability and the buoyancy of the AI optimism trade. But let's not forget that, you rewind a couple of months, or you even go back to kind of last year, and the debate was being made around, what is the sustainability of this? Are these companies going to see the investment returns that they'd anticipated? And what is the knock-on effect across broader businesses, as seen with software disruption worries, etc. So I think the surprise would be to fast forward in 12 months and there to have been no surprises about some of the technological advancements
Yeah.
that are being announced, and the potential disruption that we're seeing just completely fail to materialize. Obviously, markets are focusing on any sense that there's going to be a knock-on effect on broader employment rates. I tend to be leaning towards more of an optimistic outlook that
Hmm.
technological developments and revolutions lead to new jobs, new areas of opportunity. They are likely to lead to some disruption, but it's that
Mm.
creative destruction that ultimately drives us forward. So for it to all just be the same and everyone wonder what's next is, I think, that would be a surprise to me. We're in a very, very fast moving environment, with some very significant developments, and we are, I would say, closer to the beginning than the end of that, in my opinion.
Yeah.
So
Yeah.
I'm sorry, it's a bit nebulous, but yeah,
No, they're difficult
um, I
question to
think
answer.
the other one I would say is, if we were still in uh, a conflict in the Middle East, that would be a surprise. It would be a real
Let's
negative
hope
shock,
not. Yeah, let's hope not.
obviously.
Yeah.
But yeah, absolutely. For every reason under the sun, let's hope that's not the case.
Yes. Brilliant. Okay, well, thank you so much for your time. We really appreciate it. And as I said at the beginning, this is recorded. This will go out to those of you that registered. And we really appreciate everyone's questions as well. So the next webinar is slightly different. That will be on the 30th of June. And we've got Darren Moth, who many of you will know, who is one of our senior sales managers. And we've got alongside him Nick Smith, who is our client experience manager. And they're going to go through some details of the platform, some hints and tips of how to use it more effectively to help you in your day to day. So, walk you through some key tools. Also, going to go through our new website, which our amazing marketing team have just launched. So, if you've not had a look and checked out our website, please do. There's a lot of hard work gone into it, and we'd love any feedback. So, the guys are going to run through all of that, help you utilize some tools and perhaps some tips that you don't realize that you could do that make your day to day a bit more effective. So, slightly a different tangent, but we like to keep these webinars as diverse and interesting as possible. And I'm sure you'll all agree that today's was no different. So thank you so much, everyone, for dialing in and for all your questions. Thanks so much again, Simon. We really appreciate it. And we'll see everyone on the next one. Thanks, everyone. Thank you. Have a good day.